Hello, doctor. This is our week 5 class activity, and we are group 5. These are our group members. So now I will talk about the first part, financial ratio analysis for decision making. And the first question, compare Amazon and Walmart's return on equity using the DuPont framework. And what does the breakdown reveal about the drivers of each company's profitability? So first, let's look at the comparison between Amazon and Walmart. From this chart, we can see Amazon's ROE is 20%, net income is 59 billion, shareholders' equity is 285 billion, and Walmart's ROE is 18%, net income is 50 billion, shareholders' equity is 83 billion. So let's do the DuPont analysis. The DuPont framework breaks ROE down into three components: net profit margin, asset turnover, and financial leverage. This allows for a deeper understanding of the underlying drivers of a company's profitability. First, net profit margin. For Amazon, Amazon has a strong net profit margin, which indicates solid profitability and effective cost management. Also, for Walmart, Walmart is profitable as well, but its margin is lower than Amazon's, which slightly limits its ROE. The second is asset turnover. For Amazon as a leading e-commerce platform, Amazon efficiently uses its assets to generate revenue, reflected in a high asset turnover. For Walmart, Walmart also performs well here. Its scale and operational strength as a global retailer supports strong asset turnover. The third is equity multiplier. For Amazon, Amazon uses more debt in its capital structure. This higher leverage boosts returns but also increases financial risk. For Walmart, retains a more conservative approach with lower leverage, which helps reduce financial risk but may slightly limit returns. So about the key drivers of profitability for Amazon. Amazon's high ROE comes from strong profit margins, efficient asset use, and the strategic use of leverage. However, this also adds financial risk. And for Walmart, Walmart's ROE is solid, driven by efficient operations and conservative financial management. But to improve ROE further, enhancing profitability is key. So in conclusion, through DuPont analysis, it's evident that Amazon's high ROE is fueled by strong profitability and operational efficiency, supported by strategic use of financial leverage. In contrast, Walmart's ROE, though healthy, is constrained by lower margins, indicating that enhancing profitability is crucial for further ROE growth. The two companies also exhibit different approaches to capital structure, reflecting their respective growth and risk management strategies. That's all my part, and let's invite my partner to introduce the next part.
Hi everyone, today I will be focusing on two aspects of Amazon and Walmart's financial performance, asset utilization, and the impact of their operating models on profitability and efficiency. Then let's begin with asset utilization. So when we compare the asset turnover, the measure of how efficiently a company converts its assets into revenue, Walmart clearly leads. In fiscal 2021, Walmart reported an asset turnover ratio of approximately 2.2, while Amazon reported around 1.2. This difference tells us that every dollar Walmart invests in assets, it generates nearly double the revenue Amazon does. This efficiency is largely due to Amazon's streamlined high-value brick-and-mortar model. Their physical stores move inventory quickly and operate at scale. Now let's look at capital intensity, which measures how much revenue is generated per dollar of physical assets. Walmart again appears more efficient with a capital intensity ratio of 6.1 compared to Amazon's 3.4. In other words, Walmart generates more revenue per unit of investment in physical infrastructure. However, Amazon's lower capital efficiency reflects a strategic choice. It has invested heavily in global fulfillment centers and cloud infrastructure, such as AWS. This on short-term efficiency plays, but long-term growth drivers lie in the foundation of scalability and competitive advantage. Then let's shift to the impact of operating models on profitability and efficiency. Walmart's model is built on operational efficiency. With over 11,000 stores globally, it focuses on cost leadership and maximizing turnover. This results in solid revenue performance and strong cash flows. However, this model also comes with its margins. Walmart's profit margins is around 2.4%, which is typical for large-scale retailers operating on tight margins. Amazon, in contrast, reports a higher profit margin of 5.5%, despite lower asset turnover. This is largely thanks to AWS, Amazon's cloud service segment, which delivers high margin revenue. Amazon's model integrates e-commerce subscriptions and tech infrastructure, allowing it to diversify income streams and support innovation-led growth. So, what can we take away from this comparison? So, Walmart excels in short-term operational efficiency, delivering steady returns through a lean, asset-light strategy. Amazon, on the other hand, sacrifices more efficiency for long-term profitability, relying on strategic investments in infrastructure and technology. So ultimately, the choice between those two companies depends on what an investor values more: reliable operational strengths or innovative, scalable growth potential. Thank you. That's all my part.
Next, let's take a close look at the short-term liquidity and financial resilience of Amazon and Walmart. First, it's important to note that Walmart's FY 2021 spans from February 2020 to January 2021, which closely overlaps with Amazon's F1 2020, covering January to December 2020. These alignments ensure our comparison reflects a similar operating environment during the pandemic-affected year. So using the balance sheet data from Exhibit 1, we can calculate two key liquidity ratio, current ratio, and asset test ratio, also known as the quick ratio. So both Amazon and Walmart show current ratio below 1, meaning their current liabilities exceed their current assets. However, Amazon's demonstrates stronger short-term liquidity with a current ratio of 0.93 and an asset ratio of 0.76. Um, in contrast, Walmart's ratio are lower at 0.89 and 0.24 respectively. So this suggests that Amazon is in a better position to meet its short-term obligations, particularly when it comes to liquid assets like cash, receivables, and short-term investments. So Walmart, on the other hand, relies heavily on inventory to cover its liabilities, which may become risky if sales slow down or supply chain issues arise. So from to managers, Amazon's liquidity strength gives it greater flexibilities in navigating unexpected expenses or operational distribution without having to rely on external financing. So this reinforces investor confidence and operational stability. So, however, Amazon's position is not entirely risk-free. Its current ratio is still below 1, and its capital-intensive operations, a reliance on accounts payable, and a dependency on AWS for profitability present potential vulnerabilities. And meanwhile, Walmart's low asset test ratio highlights a pressing need to improve liquidity management. So managers should consider boosting cash reserves, optimizing work capital, or renegotiating short-term debt to reduce exposure to cash flow volatility. So in summary, while Amazon currently appear more financially resilient in the short term, both companies face liquidity challenges that require close monitoring and management. Next, let's move on to the financial risk considerations. According to the data, Amazon appears to carry higher financial risks than Walmart, based on both the financial leverage ratio 3.51 and the debt to equity ratio 2.44. In contrast, Walmart shows a leverage ratio of 2.89 and D2E ratio of 1.88. This means that Amazon relies more heavily on debt to financial its assets and operations. As a result, it becomes more exposed to interest rate fluctuations and debt repayment obligations, which can impact its stabilities during economic downturns. While high financial leverage can enhance returns in strong growth period, it also increases vulnerabilities when markets are risky. So in Amazon's case, its capital-intensive investments, especially in logistic and cloud infrastructure, requires continuous funding, making the company more sensitive to credit market conditions. So for investors, this implies the need to closely monitor Amazon's debt-serving ability and operational cash flow. Yes, Amazon's growth and profitability may justify the higher risk, but the associated financial pressure must be factored into diversified strategies. On the other hand, Walmart's lower leverage suggests a more conservative financial approach, which might appeal to risky averse investors seeking stable long-term returns. From a management perspective, Amazon must ensure efficient capital uh, allocation and maintain strong cash reserve to manage its debt obligation and avoid liquid stress.
Hi everyone, today I'm talking about the kind of leadership mindset and management approach that can help portfolio managers who are free to invest in tech company like Amazon. The real problem here is mindset. The manager is stuck in the past and thinks all tech companies as risky. But some companies like Amazon are not just a tech companies. It's a mix of retail, logistics, and cloud service. To solve this problem, we need to more than data. We need to change how the manager sees the world. This is where adaptive leadership helps. It's about being open to change and learning from new situations. The manager need to understand that today tech companies like Amazon are not the same as those from 20 years ago. They are stronger, more stable, and more important to how the world works. The analysts also use smart methods like top-down analysis and financial retails. This is part of what we call evidence-based management, making decisions using real data, not just opinions or feeling. The numbers clearly shows that Amazon has stronger performance and good returns. Now let's move to the third approach, is keeping market sensitivities. This means being flexible and addressing new market sensitivity and investment strategy over time. A smart portfolio manager doesn't avoid all tech companies. Instead, they can start slowly with companies like Amazon that are part tech and part retail. By being flexible, managers can balance safety with future growth. We also have to look at behavioral finance. Many investment feel losing money more than they get excited about gaining money. This is called losing aversion. The manager in this case is reacting emotionally. He is afraid to repeat the pain of the past. We can use Jenny's smart idea is to reframe the tech company by comparing it to something the manager already understands or respects. By changing the way the idea is present, the manager might feel more comfortable and open to the investment. The portfolio manager needs to change his thinking. He should be open to the new idea, trust read data, stay flexible, and manage his fears.
Hi everyone, I'm Li Xiao. In this part, I will talk about how to balance innovation and traditional financial performance indicators in making long-term investment decisions. The traditional financial performance indicators mainly include profitability ratios, liquidity ratios, leverage ratios, efficiency indicators, and market valuation indicators. These indicators are helpful to evaluate a company's overall financial performance. In order to make long-term investment decisions, managers need to carefully balance traditional financial performance indicators with the understanding of innovation's impact on the future growth. First of all, managers can complement traditional financial metrics with innovation-specific KPIs. Traditional metrics such as return on equity, return on assets, and profit margin access current profitability and efficiency. Innovation KPIs such as R&D investment, time to market, customer adoption rates gauge the future growth potential. For example, Amazon's high ROE reflects profitability, while its R&D investment in AI cloud tech signal long-term dominance. Secondly, managers can use scenario analysis to evaluate the impact of innovation on a company's financial performance over different time horizons. While traditional financial indicators like discounted cash flow models rely on cash flows, managers can apply DCF models to innovation projects but adjust discount rates for risk. For example, Walmart's e-commerce investments initially hurt margins but were justified by long-term digital revenue growth. Finally, it's important for managers to balance risk and reward with long-term vision. Managers should maintain a strategic vision for the company, considering how innovation fits into the overall mission and goals. In order to secure short-term profits while promoting future growth, managers should allocate a fixed budget for innovation to avoid sacrifice core performance and align innovation with long-term business sustainability, ensuring that new innovations are integrated into the company's core competencies. In conclusion, to balance innovation with traditional financial performance indicators, it's essential for managers to consider both current financial health and future growth potential, which requires understanding the risk and potential rewards of investing in technology-driven growth while ensuring that traditional financial stability metrics. That's all about our presentation. Thank you for your attention.